Let's conclude our discussion on revenue recognition. As we stated, it's I am a star. I identify the contract. S is separate those performance obligations. The T is the transaction price. Now we're going to allocate it. There it is. Allocate the transaction price back to the stuff you're going to do, the separate performance obligations. And then finally, revenue recognition. When it comes to allocating the transaction price that you expect to collect, you can break it out based on adjusted market assessment approach, an expected cost plus margin, or a residual approach, which is used in limited circumstances. But once you've allocated it to the various performance obligations, then the big thing is you want to recognize revenue. And the question is, we have two options. Do you recognize it at a point in time or over time? I'll give you the example. If I'm going to, after this particular presentation, on the way home tonight, I've been asked to stop at the grocery store and pick up some milk. When does the grocery store recognize revenue? When I'm standing at the cash register, right? However, there are other times, like accounting firms, maybe publications, maybe construction. They're all going to recognize revenue over time. So how do you make that decision? Well, first of all, does the company create or enhance an asset that the customer already controls? If that's the case, then it's over time as you're doing it. Example, if I happen to be an antivirus company and I'm going to input antivirus software onto your system over the next 5 years, but you're still using your system, I'll recognize the revenue over time. But that's not always going to be the case, of course. So then we ask ourselves the following. Does the company's performance create an asset with an alternative use? Or is it just good old-fashioned inventory? And if company A doesn't buy it, we can try to sell it to company B. Well, if it's just general inventory that can be sold to anyone, then of course it's going to be at a point in time when you sell it. But if it is not having an alternative use, then we ask ourselves one of three questions. Does the customer receive and consume the benefits of our performance as we perform? Think of a subscription to ESPN or the Wall Street Journal, whether it's on an app or it's a hard copy. You get to enjoy it as soon as they ultimately create it. So therefore, that is recognized over time. The second one, and this would be another example, construction companies. If for whatever reason, the company that's building the World Trade Center, if for whatever reason they couldn't finish the job, would the new company have to tear down everything that was done and start all over again? And the answer is no, of course not. So in this case, the party that's building it, they can recognize revenue as they're constructing it. Now, unfortunately, that won't work for, say, an accounting firm. If a new accounting firm comes in and has to pick up from where you left off doing an audit, they have to start from scratch. So there's a third option. The company expects to fulfill the contract as promised, and they're entitled to payment for the work done to date, typically say in an engagement letter, so they can recognize revenue over time. And lawyers might be the same as they're working and litigating. But I'll give you an example where that might not apply. Let's say a law firm is going to be paid based on a contingency. They get 30% of whatever the jury decision is. Well, then under those circumstances, they don't pass any of those tests, and they can only recognize revenue at the point in time that the jury awards the contract to them. So there's two different ways, point in time and over time, and you have to use this decision tree to make the decision which one is most appropriate for your organization. Now, one last item. If you have several performance obligations, it is highly possible that the first one might be over time. The second performance obligation might be at a point in time. The third one might be over time, and the fourth one might be a point in time. So they don't all have to be the same methodology. You would look at each separate performance obligation and make the same assessment that we just went through for each one independently. And that's how the revenue recognition model will work as we go forward.